Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. 1 p.m. on the East Coast, Monday, August 5th. We've been saying for a while that if the market dictated we would be back on Mondays, well, I think it's fair to say, Dan, that the market dictated us being back. Not only are we back today, from 1 to 1:30, it's going to be the two of us. From 1:30 to 2, the great Carter Braxton Worth will be joining. And then at 2 p.m., EYT will be joining as well. So this is a bit of an extended market call, sort of morphing market call and the On the Tape podcast that drops on Monday into one. But you know what? We thought the day sort of warranted and merited that.
Yeah, no doubt. Interesting setup, Guy. These are a lot of themes that I think you and I have been talking about. And, early is on time. Isn't that what your football coach used to say to you? But early in the markets can sometimes just be wrong. One of the things I think you and I spend a lot of time on, our team in general, is really kind of breaking down what we see on a day-to-day basis. We're not basically saying buy this here, sell that there, but we want our listeners, our viewers, to be prepared. Just we're calling it the way we see it. And sometimes it makes it really hard when you just see things melting up for what we think are the wrong reasons. I think that some of those reasons have been exposed, Guy Adami.
Yeah, and I'm moving closer to my mic. Jacob told me to get a little closer. So here I am. Yeah, without question. And as you just said, early in our world is wrong. But one of the things that we also said was that the things that concerned us were not getting better. The only thing that was getting better was the stock market. And unfortunately, the stock market has a way of drowning out some of the things that people should be focused on. And now everybody, obviously, today is an expert in everything that seemingly is going wrong at the same time. So we'll see. But one thing I say all the time, like I refuse to be one of those cheerleaders that are out there ad nauseum, and because I don't think it does anybody any good. And I still remember, and I'm not comparing this to then, but I remember in the aftermath of 08 and 09, people came to us and flocked to us vis-a-vis email back then. But I wish somebody had sort of warned us or showed us what was going on. So I vowed that if I saw things that were concerning, we were going to bring them to the forefront. Whether people want to acknowledge them or not, it's their decision. And if they're going to miss what was pretty significant move to the upside in the market, I mean, that's just is what it is type of thing. I think we've gotten a lot right. I think I've gotten a lot wrong as well. But, when you start to look at what's happened, and in the case of some of these technology names since June 20th, and I only mentioned June 20th because that day we talked about the importance of it. It's pretty staggering, some of these moves to the downside.
No doubt. And that was the leadership in the broad market, not just in the NASDAQ. Well, let's throw up the rundown here because, like you said, this is kind of an interesting day. You and I are going to kind of go through what we think is the anatomy of this sell-off. When Carter gets here at 1:30, we're going to look at a bunch of charts because there's a lot of interesting stuff going, given the volatility that we're seeing in single name in the indices, and he's got a bunch of data on what it means when you have this sort of downside volatility. And then when Liz gets here at 2 o'clock, we're going to focus on some of the kind of sector rotations that we've seen, right? That kind of became very much in vogue over the last few weeks, where people were saying, well, the sell-off in the high tech names or the the big cap tech names, it's okay because they're moving into other areas. Well, what we've seen over the last few trading days is that rotation was in some very weak hands, guys. So let's break this down for a second, okay? So you've been saying this, I gotta think, for like 9 months or so, maybe a little more. Danny Moses with us on the Tape podcast has obviously been talking about this too. What's been going on with the Japanese yen and the intervention we've seen from the BOJ, and just the amount of money that they've been throwing at supporting their currency. We're going to break that down in a second, but then obviously the growth scare. It's not just China. And we've been talking about this in this earnings season. We've heard a lot of things about the consumer, and you and I can speak to that. Geopolitical, like this war in Iran or Iran through their proxies. But with what's going on with Israel and Gaza and Lebanon and Iraq, that's not helping the sentiment there. Obviously, the uncertainty about the election. What else am I missing? I feel like I'm probably...
I think that's it. I mean, you throw that all into the wash and you have what we call, at least we used to call, a bit of a witch's brew here, and it's all seemingly happening at the same time. And the other thing we've said for a while is, like, I don't know why the market is choosing to ignore these things. And at a certain point, you're going to wake up one day and the market, for whatever reason, will start to interpret it. And this is anecdotal, but I guarantee there's a lot of this going on. I went to dinner Friday night with my wife, and we were talking to the maitre d' at the restaurant. And you're going to be like, why are you bringing this up? Because, what he told me is, he has a Schwab account, and he's done really well selling volatility and selling naked puts and selling vol. And what I said to him was, well, volatility had a big day today. That was obviously on Friday. And I said, I think it looks like volatility is going to be a bit of a story for a while. And what I said was, you've not been getting paid enough to take the kind of risk you've been taking. And that is one person, I get it. But I guarantee you, he's obviously not the only one. And the complacency in the market around that strategy in particular, it comes to bite you in the ass on a day like today. And what we've also said is, that's a strategy where you'll make money 80% of the time statistically, if not more. But the times that you lose it, you'll give it all back in spades. And again, you're seeing it happen in real time today. So, it's unfortunate. But sometimes you need that bit of a wake-up call. And I think you throw those things in the blender, and that's what we're seeing. And for whatever reason, the market started to take notice over the last week or so.
Yeah, and that's a great point, Guy, because that's more at a micro level about the complacency and what investors are willing to do to kind of, what do they call it, picking up, nickels off of the train tracks a little bit. But that's also a big part of what's gone on for decades now with this Japanese carry trade. So let's speak to that a little bit, because what folks were doing is kind of selling that, right, that spread, and then using the proceeds to basically buy higher yielding assets. And when you and I have seen it in our career, when that comes unwound, it has massive implications for risk assets all over the world. So this is one of the reasons why you've been talking about this Japanese weakness and what the BOJ has done to combat that. And you said, it's literally like pissing in the wind a little bit. If you think about, I don't know if you said that.
Again, this is, Danny talks about this, and it's important because I think this is the crux of what's going on. You'll hear about the yen carry trade and the unwind, and this has been going on for literally decades in some way, shape, or form, where people have been taking advantage of, again, the differentials between the U.S. and the Japanese yen and interest rate differentials, and using the proceeds to buy assets. The assets, in this case, have been predominantly stocks, predominantly these high valuation, high growth technology names. And when it starts to unwind in the form of, again, Japan raising rates to combat the inflation that they've been begging for as well for many, many years, at a certain point, something's going to trigger. And for whatever reason, the trigger started in April at their first intervention, and then again, a month and a half or 2 months later. And that finally those little embers caught into a fire. And here you go. This is a currency. This is I believe, Dan, correct me if I'm wrong, I want to say it's the fourth largest economy in the world still, in the form of Japan. And when you see their currency move like this, I mean, bad things happen on the back of it. And, they're dealing with their own things, but the knock-on effect is obviously taking place and taking hold in our markets in a major, major way. And it's not just currencies. You're seeing it on all kinds of sort of risk assets, the deleveraging that takes place, and obviously the margin calls that are taking place that are taking all assets down along with them.
Yeah, and I would just want to make the point, maybe Jacob can back out this Nikkei chart like 40 years. I don't know if they can or not, but it felt like, Guy, in some point in June or early July, when the Nikkei finally made a new high.
And if Jacob can put that chart you asked, I know, but look at the double top in the Nikkei. I mean, and we actually sort of pointed this out, but please continue.
Yeah, and the point I was going to make is that it was like a universal undervalued trade just about a month ago. You know what I mean? And, when you think about that, it's kind of, and Carter and I will talk about this in a little bit. And that was his point about yields when last fall, the narrative was higher for longer. He's like, well, that's when you want to sell. And again, maybe this looks like a little blip right now, Guy, but we've taken out, a whole year of performance, if he wants to go now to a 1 year chart, in about a few days or a couple of weeks or so. And so one of the reasons why, I don't know much about this sort of stuff. I'm going to be really honest with you. Okay. About, the knock-on effects of the unwind of a carry trade in Japan or this and that, whatever. But you've been mentioning this for so long, you've been saying that at some point, something's got to give. You know what I mean? And if you don't think a down 12% day or a down 15, 16% in 2 days is something giving, like this is the sort of damage that you just don't come back from in a week or two, right?
No, it does not. No, if you think you're going to recover from this over the course of a couple of days, the damage has been done. Now, with that said, you're going to get some bounces along the way. I mean, we had 130 handle bounce in the S&P from today's low until the high we made about an hour or so ago, and you're going to see moves like that. But if Jacob can sort of move the cursor, put that Nikkei chart back up real quick. Sorry, Jacob, I apologize, but you'll see a classic island reversal and go back over to the left, bang, right there. And I don't know what day that was exactly, Dan. You can probably see it better than I can, but that is a classic reversal signal. And I think we actually talked about it. And then we actually overlaid that with the longer term chart and said, this goes back to 1990, I think, these tops. Yep. And, if you're not paying attention to the fact that we stalled where we stalled some 30 something years ago, I mean, you're just not paying attention. So again, why did it kick in now? I have no idea, but that's what's kicked in, and the market's starting to feel the impact.
Well, I mean, listen, and maybe Jacob can throw up the CME FedWatch tool. Japan is raising interest rates. Last week, they raised them like higher than expected, right? We're talking about 50, 75 here. They went from what was expected 10 basis points to 25, and that kind of spooked people last week a little bit. And now you just see what's happening here. The probability of think about this. A couple months ago, Guy, we were saying no way September, because it would just be too political, this and that, whatever. Now we're getting to a point that feels a lot like late 2018, where we had that sell-off of 19.9% from October into Christmas. And listen, that's the thing that's interesting to me, Guy. That turned the market sentiment on a dime back then, right? And then we had a good 2019 or so. It just doesn't feel that the Fed can do that right now.
It's again, I saw Jeremy Siegel on this morning. Emergency. Now this is not me being funny at all. What's the emergency that the Fed rate cut would fix? Like, what is the emergency right now? Like, other than the stock market being lower,
right?
What is the reason for it? And there is no reason for it other than the stock market being lower. So the Fed's job isn't to moderate the stock market. It's not to make sure the stock market goes higher. Right. It's for price stability and other things and full employment and those things. Now, if you want to tell me they're late to the dance because the unemployment rate has started to, we talked about that a couple months ago. I mean, we talked about it in the fall, how you're going to be surprised this year. I thought it would happen sooner, but it's happening now. How quickly the unemployment rate would start to kick higher. Liz Young Thomas talks about the SOM rule all the time. That was kicked in on Friday when you saw that 4.3%. So all the warning signs have been there. But an emergency Fed rate cut because the stock market's lower is asinine. And actually, to be honest with you, and I tweeted this earlier, it's actually the last thing you want right now. It just makes this unwind trade. It just sort of puts gas on the fire. And it's funny. Somebody put this on Twitter earlier, and I laughed because, they said that if Fed were to cut 75 basis points, they'd make Arthur Burns look like Paul Volcker, which is really, for you, armchair economists like me, it's actually very funny. It's actually happens to be true. But with that said, now you're starting to see the certainties around, 25 to 50 basis points of cuts and what we're looking at now. But if you think that somehow is a magic bullet for, it's just not.
Well, Guy, I could make one argument about the Fed cutting more than was expected not too long ago. When to your point about unemployment rate ticking up, I mean, just like they were slow in 2021 to recognize the quick rise in inflation, and they were late to that, Fed Chair Powell said this, I want to say a few meetings ago, that they're not going to wait for inflation to get to their 2% target. And we made the point. It's not that inflation is 2% the way it was pre-pandemic. It's up 20% cumulatively
Yeah.
since before the pandemic. But he said that they're going to start normalizing interest rates or bringing them down because, you and I made this point, the long and variable lags, right? It takes a while for this stuff to kick in. So to your point about the SOM rule, which is, unemployment going up and yada, 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 and as a recession indicator or whatever, I mean, maybe they were late to the game now. And that really, the scare is about growth here. And if we're seeing the weakness that we've seen just in the last 3 to 4 months in the consumer, kind of fixing or moderating, like interest expense and all that sort of stuff makes some sense because you and I have been talking about it. The tick up in auto delinquencies, the slowdown in large purchases like autos and the like, you're seeing it. And then I guess the other point I'll just make is like, well, the one thing I left out of that Witchs Brew formula guide was the popping of this generative AI bubble, right? And so if you don't see the monetization of this stuff and CapEx has been on a huge binge, then at some point you're going to see CapEx come in, and you're going to also see in these efforts to kind of, if their demand is slowing a little bit, you're going to see more headcount reduction. And we've already seen that, Intel's been firing people. We've seen it from some others. So I guess, they've been late to the game, in 2021. It seems like they're late to the game, in my opinion, in 2024. And the point is like, they don't know any better than we do. They have better data, but they seem to be poor market timers or economic timers. I know.
Well, I mean, the market's been lowering rates for them. So again, and how many times has Danny said this? Carter, I mean, I can count at least 10 or 15 times that Carter said at a certain point, lower rates will be negative for the market. We had that conversation over and over again. And clearly that's exactly what's going on, because if you're paying attention, which you are, obviously, I mean, the market's been lowering rates for the Fed for the last, couple weeks, if not longer than that. So it's not interest rate, it's the lower interest rates apparently are not the cure-all for everything. And you're seeing it right now. And by the way, I don't know if it happened today or not, but I think the 2s, 10s actually went to parity at one point. I don't know where it is right now. I don't have it up, but that's interesting.
It's like 11.3 basis points.
So it's back to, okay, fair enough. But I mean, that's all over the place too.
I'll look.
And NVIDIA, I mean, again, I don't really care one way or another. I don't, because these are just companies to me. But on March 8th, we had a conversation about NVIDIA. That proved to be spot on. On June 20th, we had the same exact conversation. And we said there's a very good chance it fills that gap to the downside, which I think was around 95 to 98 or something. Yep. Pull up a chart. I mean, look at, pull your cursor over to that gap, Jacob, and you can see, and thank you. And look at what we did today. So you have this gap fill. Can it trade down in the moving average? Yeah, I guess at some point. But, now is the levels where you start to thinking about, okay, maybe it actually starts to make sense. At least technically, it's done the work that's required.
Yeah, you made this point a lot on Fast Money, on Market Call, and on the tape, that the panic in the markets over the last few years has basically been to the upside. And you always think it's kind of funny. You highlight the fact that, we get very few panic days to the downside. We talked about that a lot in 2022, that was a really orderly sell-off. At one point, the S&P was down, 27%. It didn't really crescendo in a sort of downside volatility way until that late October, point. And then it was kind of off to the races. And we had plenty of days that were up 1.5%, 2% on whatever the heck it was. So, interesting stuff to me. I think you and I both feel like the idea that we get back towards 5,000, that's that 200-day moving average, seems like a good level. It would be down, I think, about 15% or so from those recent highs, 13, 14% or something like that. So we will see. The one thing I left out of that Witchs Brew, though, was the Gen AI thing, guy, which I think is interesting. But let's hit first the consumer. And just so you know, and I know this is probably this band, there's no songs on your 900 or something Spotify playlist, but tonight I'm going to see Green Day. All right. I
love Green Day
at Shea Stadium, which I know that you will never step foot in for the rest. I know that. Didn't you see the Who at Shea Stadium?
So in 1982, the Who was doing a tour, and I went in October with my brother Chris to a misty, it wasn't rainy, it was one of these shitty October nights, to see the Who at Shea, because there was no alternative, and I wanted to see the Who. It was David Johansen was the first act. He got booed off the stage. The Clash came on next. They suck. they didn't get necessarily booed off the stage, but we're counting down, and then the Who came on. The first song they played was Athena. I remember it like it was yesterday. But short of that, there's no compelling reason to ever go to Shea Stadium or whatever they call this new place that they play in. But please continue.
City Field. So tonight I'm going to see Green Day. The Smashing Pumpkins are opening for them.
Oh, I love the Pumpkins.
They will not get booed off the stage. But, earlier this year, Green Day came out with a new album. And, I think you and I feel very similarly about this. A lot of great rock and roll bands should stop making music once they get to that 25-year period or something like that. This album, The American Dream Is Killing Me, I put it up there with, some of the albums that they had in the 90s and then into the 2000s. It's awesome. But, one of these lyrics I think is really interesting when you think about the consumer, you think about the impact of generative AI. This is how it goes. The American dream is killing me. People on the street, unemployed and obsolete. Did you ever learn to read the ransom note? I just think this, so don't want to be no huddled masses, TikTok and taxes under the overpass, sleeping in broken glass. Okay, so think about those lyrics, okay? It's talking about a little a level of disillusionment, right? And so think about that. You talk about all that time. You talk about who's getting screwed, right? In a lot of these situations as it relates to the Fed and their hubris about what they can do with interest rates. And I think that's one of the things that's been very prevalent throughout our society, going back to the financial crisis when everybody believed that there was their right to own a house, you know what I mean? Or maybe two houses and the like. And then, who gets bailed out? It's the, big corporations and people who own risk assets and the like. And a lot of these other people who were kind of, trying to get ahead or whatever, kind of got screwed. And then all the movements, as you think about it with interest rates and the like. So I don't know, thoughts there, guys.
No, well, I mean, and we'll look at, and we should pull up some other charts too, but yes, you're 100% right. And the Green Day, I'm sure they're lovely, and I'm sure it'll be a lovely concert tonight, and yay.
It won't be misty.
You think about the people that got hurt, when the Fed was begging for, the people that get screwed on zero interest rates and easy money are the middle class and the lower class. The rich people, they're the ones that love that. And who gets screwed on the way out when they try to normalize rates? Not the rich people. I mean, inflation to them is a joke at a cocktail party. It's the same people. They get screwed on the way in and they get screwed on the way out. And it's happening in real time. And it's unfortunate, but central bankers globally somehow think they're the purveyor, the all-knowing, and their machinations can somehow fix things, when in reality, it just makes it worse. I mean, right now, if you think about it, all the problems they're trying to solve for over the last 15 or 20 years are the problems they created in the first place. So, I am not a fan of central. I'm sure they're lovely people, but they're the crux of all that's going on. And you go back to and Danny Moses talks about this. It's a great experiment that started with the Bank of Japan. At a certain point, it all comes home to roost. And for today, at least, that's seemingly what's going on.
Yeah. And so we got to hit this. So just to put a bow on that, I mean, the consumer and a lot of what we heard, and we've been talking about it over the last month with Q2 earnings season, is the weakening of this consumer. Now, those with the pom-poms were just kept on saying the resilience of the consumer, and everything that you and I were looking at, whether it was the finance companies, whether it was consumer package companies, whether it was high-end brands, all the way from Burberry and Gucci down to Nike and Lulu. I mean, the list to McDonald's and Starbucks. I mean, the list went on and on and on. And so if you weren't paying attention to that, you were just ignoring what was very obvious that these companies were telling you. It's just funny to me that if the companies are telling you that, and you're not paying attention to that, it just seems like, careful at your own risk. I want to go, we don't have to talk about NVIDIA anymore because 40% of the revenues, right, comes from Google, Microsoft, Amazon, and Meta. And we've been talking about that. And one of the things that we heard last week or two from these companies is that, the CapEx is still there, but the monetization opportunities don't seem to be there. And this is the one thing I want to go to Apple, because Apple finally joined the party, guy. As you remember, going back to June 10th, WWDC, you and I were sitting on the on the Fast Money desk that night as we were kind of analyzing what came out. The stock closed down 2% that day. So it meant that investors, at least for that few hour period, were not particularly excited. Look at that move, that 2-day move. We just like obliterated that on the opening. We opened at 199 today. Now, if Jacob can pull up a 3-day chart, Now, we also know what happened over the weekend, that Warren Buffett disclosed that he sold half of his position that he started building 10 years ago. So good on him. Okay. He's made tens of billions of dollars in this sort of thing. But you look at that, and what does it say to you? That this Apple Intelligence, there was also some reports over the weekend. This guy, Mark Gurman from Bloomberg, he's like the axe in the stock. He's not an analyst, but his analysis, he said this thing sucks. You know what I mean? For all intents and purposes, I'm paraphrasing. He didn't say that. But we also learned last week that a bunch of these sorts of whiz-bang sort of things that Apple talked about are not going to be on this new iPhone when it ships in October. So the story sucks. Let's go back to the 1-year chart. In my opinion, you've been talking about valuation. So thoughts there, because it joined the party late and it just gave up all that stuff. But it's trading now back at 211, traded down to 199, guy.
Yeah, well, I mean, you started it, and that's how I'll start it with, when Warren Buffett does something, you don't have to agree with him, but you got to take notice. And, we mentioning Doug Cass has written about it. The Buffett indicator had been flashing red for quite some time. And, when he decides to cash out of positions, you got to take notice. I mean, Bank of America is another great example. He sold probably not enough in retrospect, but he sold a significant portion of that stake. He obviously is paring down this Apple position in a pretty major way. Why do you think he's doing that? What does he see? He probably sees the same slowdown that we've been talking about for a while. And as we've said for a while, companies like Apple will not be insulated from it. And I think to a certain extent, that's what you're seeing now. So yes, and then you throw valuation on top of that, and it all starts to make sense. But when things are going up each day and you try to bring up those points, with each passing day, it's the boy that cried wolf stuff. Nobody wants to hear it until something happens, and everybody's like, "Why didn't you tell me?" And that's the sort of the struggle that at least that I sort of deal with. Not a struggle, but that's the sort of the balance beam that I try to walk on a daily basis.
All right, let's talk about just really quickly the geopolitical stuff, because I don't think we can put too fine a point on this. It's like, I think it's really dampening sentiment like globally. I feel like we heard this a bunch more in the Q1 earnings period from some of these, consumer companies that like they were using it as maybe a little bit of a mulligan. But when you think about the potential for a much wider conflict, you know what I mean? It definitely has the potential to, to kind of weigh on consumer sentiment globally. And I just want to talk about crude for a second, because this is one that we thought, and we were doing a trade on this using futures, I think it was like 82, and we kept on moving, the stop down, right, to the upside. It wasn't really needed once it got through that 200-day moving average. And you look at this, it got back this morning, guy, to those May lows a little bit. And you and I talked about this last week on Market Call. It's like, if it can't rally, that being crude, given what's going on in the Middle East, then is it the potential for weak global growth weighing more on it than geopolitical stuff? Thoughts there? Because I know you look very closely at crude, but if you think about how many names have just given up their 1 or 2 year gains in the stock market in such a short period of time, there's no reason that this might not go back to those late 2023 lows, which is briefly below 70, guys.
65 to 68. Now, listen, it makes sense. And you've said it, each rally it's been foolish to chase. And this last one, I actually said, you know what, I've been burned enough times to know that this is probably going to be the same type of thing. So we're down to those levels we saw in June. That makes sense. Ultimately, can we get down to the December levels from last year? Maybe. The rub is going to be, what does it mean for the energy stocks? Is it going to be a rotation into some of these names on the back of it as people get out of technology and into energy? And that's obviously, days like today is not the day to sort of gauge that, but that's sort of the bull case, I think. You don't need, we've said it for a while, you don't need the underlying commodity to sort of rally in the meaningful way in order for these stocks to get off the mat. You just need for there to be a rotation. And real quick, before I sort of get out of here and Carter jumps in with you, we got a couple questions. Akash asks, why do you guys like volatility? What does it allow you to do that you couldn't do before? Well, it's not that we like volatility. What we've said, Akash, is that volatility was being dampened artificially for a number of different reasons, and it wasn't really showing the true risks associated with the market. On a day like today, I think it's sort of, it pulls back the onion a bit. You see some of the risks associated with some of those things going on. So it's not that I love volatility. What I don't love is a complacency that's associated with the VIX that was trading in the low teens, Dan.
Yeah, and again, I think if you're a shorter term sort of market participant, it does provide opportunities to kind of add to things. And we often advocate that whole notion of dollar cost averaging, right? And so nobody is going to be a perfect, market timer here. And if you have certain conviction and your time horizon is something longer than, let's just say, a short time period of volatility, you know what I mean? Then you have the opportunity, if you've been averaging in on the way up, to kind of do so in a quick downdraft or whatever. So that's one of the reasons why, especially after a extended period of low vol, sometimes you shake out some of the weak hands and then it provides you plenty of opportunities. So, here was a name that you and I briefly talked about, Guy. There was outages on a lot of these, brokerage firms, online brokerage firms, which we've become a very accustomed to on big downside, kind of volatility days. But look at Robinhood. Okay. They get, I think, 40 some percent of their revenue from options trading. Friday was the largest volume day in the options market ever. Look at the volatility in crypto, right? If you look at, they get, I think, a bunch of their revenue from crypto. Those are also very high margin sort of products for them. And look at that 2-day move. Here's another thing about this company with where the market cap was and the enterprise value, their cash. I think they have like $7 billion or near that in cash. I think they have $4 billion in debt. But again, that's a great balance sheet. I think there's a lot of other financial companies that wish they had that sort of balance sheet and also wish that they had that exposure to those sort of revenue things. Thoughts on that really quickly,
Yeah,
guys?
and no, and I listen, to a certain extent, I guess the move makes sense vis-a-vis what's happening in Bitcoin and stuff. But if you think about it, I don't think Robinhood was down today in terms of a trading platform where others were. So, it's days like today that you test your mettle. And I'll say this, Robinhood is one on this sell-off, which has been pretty steep, that I think you actually take a look at. I don't know if you have the volume in front of you. I don't, but I'm guarantee it's probably on pace to trade 3-4 times normal volume today.
I'll give it to you. 1 second here, Guy. That's one of the things. I go to my little fact set machine here. Volume looks like 33 million shares already.
And what does it typically trade? About 8?
Yeah, something like that. So it's pretty fascinating
Yeah.
here if you think about that. All right, Guy, Adami, I know that you have to work.
I'm running into the city. We had an unscheduled show today, but you're in good hands with Dan and now Carter, and then subsequently EYT. So when I leave, Carter jumps in. So thanks, folks.
Yeah, thanks, guys. See you later on Fast Money. All right, Carter, Braxton, Worth. Oh, there he is. Of Worth.
There he is. There you are. Hi.
Thoughts here, Carter, because listen, you and I, we spent a lot of time together. I was stepping all over your some of your fine work on Fast Money on Thursday. We were talking about some of the reports that you had out on your service, Worth Charting. By the way, I say this all the time. The work that you do, you're very deliberate about the reports that you put out to your subscribers. Obviously you don't want to bombard everybody, but you like to kind of put a fine point on the things that you think are most important. I think late last week on Thursday, you were talking about what happens in a stock market that goes down 5%, and you kind of updated some of that work today. Do you want to walk us through a little bit about that? And then you and I can kind of broaden out the conversation. I'd love to kind of get a broader sense of kind of some of the things that you're seeing. I know that you do, kind of deep work that goes under the surface of the markets here. So we'd love to hear about that.
Sure. Well, just to put in context before we look at any charts or tables, I guess the conversation we were having as a group last week was that bouts of volatility, right, are signal something imminent, typically something violent. And so if you think about, again, this is a sort of a life principle, or if you're in a relationship that's smooth and all of a sudden it's getting a little bit rocky, you're in a job and all of a sudden there's confrontation with the boss, or in a stock or currency or whatever it might be, you get that kind of or as I see you're going along in the family wagon, just cruising along the road, and you hear a little brrr, what was that? That's weird. And then you hear a taka 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 taka, what was that? And all of a sudden, boom, the hood blows off. The point is, strange noises out of nowhere aren't for nothing. And so when you get these bouts of volatility, they foreshadow typically something's wrong. And sure enough, look what's happened here. We have now stocks like Robinhood down 40%, which is sort of a low, not to say low quality, but a low priced sort of new operation, but you've got things like Micron also down 46%. So big names, small names, but the aggregate, and let's talk about the aggregate. The market now, from its peak of July 16th, this sell-off is exactly 14 sessions long, right, in terms of duration. And on the low today, we were down some 7.9%. I'm sorry, 9.7%. So take a look. If we have any data tables, we can maybe put those up, but if not, that's fine too.
You one quick question here, Carter, before we get to those. So what's different about the 5% sell-off that you kind of talked about with us on Market Call last week and on Fast Money, and the sort of 5.5% sell-off that we had in April? Is it that we are so much higher that the market rallied to those July 16th highs off of those April lows, another 15% in a very low vol way?
Yeah, I mean, so the idea is that why is 5% important? One could say that's arbitrary. You could have done a study around 4%, but we did a lot of work on it years ago. I mean, you're talking about 20, 25 years ago. And what we found is there's something about 5%. So think about it. If a stock, anyone owns a stock and it goes up 1%, you're not thinking about selling it, or down 1, up 2, you own some cotton or cocoa or oil, it's up 3%, it's down 4. Something happens at down 5. And typically, whether it's because people actually have stop losses entered and the triggers, they get hit, or discomfort levels, or risk managers, hey, we got to talk about this. But once you go down 5, you typically go down more. And so this sell-off obviously is more at almost 10% versus the April sell-off, April 1 to about April 17, which was 5.9%. Why this is more severe? I think things have changed, at least in the mind of market participants. There was that much more money pumped into AI names. There was that much more belief in the Goldilocks scenario. And now the thing that was hoped for is not actually working. People have been hoping for a Fed cut and lower rates. Well, you got them, baby, and it's not helping, right? So that this is worse by that measure, and the sell-off is worse. But also, look, you get an intraday ricochet that's even more pronounced. So this volatility, the question is this, and this is whether we trade it or not, whether one has already made a fortune off the low today, or one has been short and covered. What does this mean looking out 3 to 6 months? And the first thing it means is that damage has been done. Money's been lost. And the complacency is at an end. And you will have people who get statements who don't follow the market day to day, hour to hour, as many of us do, golfing today, sailing today, just with their grandchildren today, wherever it might be, who are going to start to look over and say, oh, this is a little bit not what I wanted. NVIDIA, I believe in this, but do I? And it's down 25%. And you'll have people back away, typically, from the market.
Yeah.
But if we want, we can look at the 5% in more detail.
Yeah, I would love to see that. I saw the report earlier, and it might be very useful for some of our watchers, listeners here. So walk us through that. And then I definitely want to talk about rates, because you've had a great call on that too.
So what this tries to do is look at every instance where the S&P has dropped 5% or more, when that trigger. And it's happened 241 times, this one being the 241st, you'll see there. And there's sort of statistics around it, for lack of a better word, statistics. The once you go down 5, the median decline, you see it on the screen, is 8.23. And the average is 11.8. And they typically take place over 20 to 30 sessions. So this one is now smack dab in the middle. It's a little bit shorter in terms of duration. It's 14 sessions. But the idea here is that it's normative. I mean, I think that's the thing to say, right? It's normal. There's nothing abnormal about it. Now, individual securities, Robinhood or Micron down 45% plus, that's a different matter. But there's nothing outsized or irregular about this. The one thing that does jump out, of course, is that we are doing it fairly quickly. The VIX has now spiked to one of its biggest spikes on record. But anyway, what does this mean looking out, longer term? All intermediate tops, I was taught, must be treated as though they're major tops. So this is clearly an intermediate high, was made on July 16th, and most stocks are down considerably over the past 3 weeks since that high. Does the market bounce and go on and make a new high, or is this an intermediate top that ends up being something more important? I'm in the latter camp.
Yeah, and Guy and I just talked about all what we think are the reasons why this all kind of came together a little bit over the last week. Towards the end of earnings season, I think the generative AI bubble is starting to pop a little bit. I think there was so much money concentrated in this trade, and when you think about Q2 earnings and what the guidance was, it just didn't come up the way that a lot of investors were very optimistic about, trying to see some of the kind of near-term monetization sort of stuff. So that was one aspect. Some of the geopolitical stuff is another aspect. Some of the uncertainty around the election. I mean, this is one of the craziest months in politics here in the US in a very long time. Obviously, what's going on in Japan, and then just the kind of consumer situation and some of that data that we saw late last week with the ISM and the unemployment stuff. So there's a lot of stuff to kind of get focused on. But I want to go to rates here for a second because, again, I got to go back to the fall when we had a 10-year at 5%. Everybody was talking about soft landing. Everybody was talking about, look, the economy can withstand rates up here. The markets can, deal with rates up here. We're going to go into a soft landing. Higher for longer is fine for all those reasons that we just mentioned. And you were saying, well, as soon as we start putting monikers around price action, whatever the risk asset is, it's probably usually a time to fade that. So here we are. We went through the lows of late last year. Where do you think for 10-year right now? Because if CME Fed Funds Tracker is pricing in the potential for a surprise cut, right? And then the certainty now of September, which was not something that we were thinking about just a couple months ago.
Yeah, I mean, look, it's all extreme day to day. So if one is a day trader or fairly quick and nimble, you play for the bounce in the equity market. You fade the 10-year bond and the 2-year note, the note themselves, not the yield, because it's all a bit extreme. But what does it mean more structurally? And that's the issue. Let's go back to the chart of the and do a 2-year duration of this 10-year yield chart, and so. If you can see this, the higher for longer, we never once got above 5%.
Mm-hmm.
They were talking 7. Second,
Jamie
do you know how
Dimon
many
was
weeks?
talking 7.
There's 5%. We didn't even get above 5. I mean, the whole thing is preposterous. And the second, if you put the line on 450, put the horizontal line on 450. Do you know in the past? So 52 weeks in a year, past 104 weeks, we were above 4.5% for 9.
Yeah.
I mean, above 4.5, that's not high or anything. And so the question is really, who the heck knows? I don't know how much lower it's going, but basically, I remain in the long precious metals camp, long bonds, i.e. higher yields, and I don't trust this market. It's steep, expensive, it's overdone. No one can say, yeah, but you missed the rally. I don't like the risk reward of it, and the market has its issues that have, I don't think, been resolved. So no change to the thinking on the stock market, no change to thinking on the bond market, and no change to thinking on the precious metal market.
Yeah, really, really quickly, if Jacob can pull up the 2-year, because again, this got to that spread steepened. It got to basically parity earlier today. Now it's about 11 basis points. But this is obviously more indicative of what the Fed might do here. That's a 2-year chart when you think about that. So trading at the lows in, a year and a half or something like that. So that, is also pricing that sort of action. And Carter, how important are charts on yields? When we go back to that 10-year over a 2-year period, it looks like it's making what appears to be a head and shoulders sort of top, and you see where that kind of neckline is there. Thoughts on that? I mean, is that something that our viewers, our listeners should pay attention to? That are the technicals important in one of the most liquid assets on the planet?
It's the same thing. I mean, people say it's funny because it's all come of age. Like when I started, it was with pencil and paper, and you had to draw your trend lines, and no one believed. Now with computers, everyone buys a chart package, and thankfully, everyone believes. And Ray Dalio and Jim Simons, ones and zeros, they've kind of proved right that there's a lot of wisdom in studying price. But the thing about people say, well, what you're saying is like, would it matter? One of the most important issues. So it has always been, and maybe it's a bit different now, but in my entire life, the total value of all stocks traded in any given day, total value, the bond market is double that, and the currency market is double that. Now, having grown up in Manhattan, I have a lot of friends who ended up being chief dealer euro yen or pound dollar. Now, currency traders on major bulge bracket desks, they're looking at balance of payments and GDP, but you know what they're really looking at? They're looking at charts. So the biggest market by far, the biggest security of all, US dollar, charts matter. Just as they do in Bitcoin, people are charting Bitcoin and so forth. So there's no change, no difference whether it's a yield chart or a cocoa chart or a dollar chart. We're studying price. We're looking for transitions, pivot points, breakouts, breakdowns, levels of support, looking for trends, changes in trend. Anyway, yes, day to day, it's overdone. We've got the gap. Perhaps you rally back, but ultimately, what does this mean? I think it means continue to stick with the lower rates theme, higher precious metals theme, and be careful, wary of the stock market.
All right, let's talk about some single names here. And I just want to start, maybe they can pull up an Intel. They could start with a 1 year, Jacob, and then go to a 5 year. And again, this is a name that it's a obvious value trap, right? And it's down from $50, just earlier this year. Now go to a 5 year chart. You see that massive gap. You see the follow through today. And I'm not even going to ask you to chart this. It doesn't really matter. But it brings me back to, you ready for this? July of 2000, there was a company called LSI Logic. It got bought by Broadcom then, okay, or in 2014. But there was a Q2 report in July that really, I think the stock got absolutely killed based on the guidance. And a lot of folks, we topped out in March of 2000, but a lot of people didn't believe it, right? They were always looking to kind of buy the dip. We've seen that in every big volatility period. And so I just kind of go back to that period because I've been saying this, you've been saying this, Guy's been saying this. While the companies are very different this time around with the generative AI story, to me, the psychology around it was exactly the same. It is exactly the same. The air is coming out of this thing, and I think it's over. I think NVIDIA at $140 put its high in. The fact that, and I want to go to Apple here for a second now. So the Intel thing is interesting to me because here's a company that was one of the largest companies in the world 25 years ago, and it's dying right now, okay? They just cut their dividend. Their guidance looks horrible. Their CEO is going to be out. He was the CEO who came in a few years ago, supposedly to turn it around. So then Apple. So, we talked about this last Thursday, and I asked you the question here that if it were to kind of get involved in this broader sell-off as it related to generative AI that we've been in, for the last few weeks or so, where does it go? Well, let's go to a 1 year chart for a second. You talked about the underperformance relative to the S&P. And just speak to this because I asked you where is it going, and you said it's going back to $200. Well, it opened today at $199. Now let's look at a 3-day chart here. When you look at this, that gap to $199, Carter, and then you make up that ground. Talk to us a little bit about the short-term action, and let's go back to the 1 year so you can speak to that, what you'd be doing with a name like this after you called it where it should go.
Well, right. So if we do the 2 year chart and look at the level to which it gapped down, right? It finds support at the tops from which it broke out. Now, the truth is, and this is going to be the case with almost all securities, this is where you bet against volatility. You do not get repeated bouts of volatility after a spike like this, history shows. So no one does it, but I would sell the 220 calls. I'd sell the 190 puts. You do them for August. You got 1 week to go. You keep it all. More likely than not. Now the question is, you could say, yeah, but if you're going into this worst scenario, wouldn't Apple be down at 180 or 170? You can adjust your points and so that you can get paid while you wait for that too. But ultimately, here's the question: is Apple, after breaking out like that and now falling back to the level from which it broke out, is Apple at risk of, for instance, going to the bottom of the range? That would be extreme. But were that to happen, get to 175 or thereabouts, that would not only fill the gap of May, but that would be a buy as much as you can. There are two things going on. Operating business is one, no matter what the business is, toothpaste, or in this case, phones and whatever they do. But there's also something called cash on the balance sheet and moat like this at 175. If one were so lucky, I would buy it all day long.
Yeah, no, I mean, again, you probably, in my opinion, go back and sort of test that low that it made this morning, a panic low, 199 at some point. I just think that, again, I'd be shocked if a company like this is able to get the product out. That was the other piece of news, and Guy and I talked about it a little bit, is like there was so much short-term excitement about what they launched, you know what I mean, as it relates to their Apple Intelligence product and what that would mean for an upgrade cycle. And I thought it was a bunch of, BS. And so like when I think about this, is like if we're going to be selling rallies in tech for a while, this is going to go back and it's probably going to touch your 150-day, which is 197 down there or something like that, 196. I mean, that's just my 2 cents. And they're going to take the air out of this one a little bit, especially as we head into the fall. And there's a lot of uncertainty about this upgrade cycle. I want to ask you another question about, you have a gap lower, that term, I don't know if you use it at all, but a spike bottom, right? So you gap lower, you have this huge range, and then you basically reverse higher, and it looks like actually a spike if you close on the high, if you're looking at a bar chart, right? So on the left side is the opening, and on the right side is the close, and the distance between the two of them is the range that the stock traded on the day. So when you see that sort of price action close on the highs, let's just assume this thing gets back up to 215 or something like that and closes there. Do you generally see a follow through, to the upside if you get that sort of price action?
Well, almost every stock has that circumstance today, right? So open on the low and has recovered all day long. So big bars, wide-ranging bars, and most stocks are at or near their highs of the session. So something of a capitulation type day. We've been selling off for 14 sessions for the market. In many stocks, it's more like 25, 30 sessions. And so to some extent, on a sequencing basis, you've reached a point where people who puked in the morning, that represents other people stepped in and did some buying. And so we have set a range now, more likely than not. As to whether this follows through or fades, that is just a 50-50 guess. Closing on the absolute high is important. If you're going to follow through the following day, perhaps fill the down gap from today. So the close is pretty important today. And that's the irony of it all. Here we are at 2 p.m. The whole thing could crap out and we could be at the low of the day. Just as easily we could stop right here and be at the high.
I want to talk about that. If it were to do that, if we were to get weaker in the afternoon, then would you expect a follow through to the downside?
Sure.
Yeah. Okay.
Yep.
And so I want to pull up the NDX chart. Okay. This is the NASDAQ 100. So from its highs, I want to say it was July 11th to its lows this morning. It was down about 15.5% or so. It cut right through your 150-day, and to the penny, Carter, to the penny on Friday, it stopped at your 150-day. All right, that's the 200-day that Jacob has up there, and so we sliced through it. We're still below it. What do you expect on something like this? Because it really feels like it took a lot of the froth out that we've seen over the last, call it 2.5 months or so. It kind of seems like in no man's land here. And do you want to be selling rallies in the NDX?
Yeah, but you can get a really substantial rally. The most violent moves up in all markets, securities commodities, are in securities that are in downtrends, right? The biggest couple-day moves that you'll see is something that's depressed, that rallies, comes off of and so there's no reason you can't get that. Look at the substantial rally you've had from the low. Where would you fade this? You'd fade it from Friday's low. If you get back above.
Yeah, 19. Yeah, just below that. I want to go back to another name that I think is really important away from the tech trade, and that was JP Morgan. This is one that I think not too different than Lilly. These became very large market caps. They were unabated new highs, I think all of June, right? Into those highs. You look at this JP Morgan, which was literally at an all-time high or 0.5% from it early last week. Okay. And, folks say this all the time. We don't crash off a high as well. Not that was exactly, a crash, but if you look at your 150-day, it's just right at that 50-day. How does this thing look to you? It doesn't look too different than some of the other things we've looked at, but it's massively outperformed so many other, money center banks over the last year and a half or so.
I mean, it's all the same circumstances, just rates of change, right? And the magnitude of the give back in relation to the preceding advance. But the common circumstance in the market are most stocks, indices, individual equity are in uptrends, and most have taken a hit here. Most have sold off, meaning these counter trends, whether they're 3 days old in the case of JP Morgan or 13, 14 days old in the case of the S&P, at some point you find your footing. And the question is, and this is, do you play it for a 2-day bounce and then it fades? Does it go on to make new highs? Many people believe that's the case. You buy NVIDIA here because NVIDIA is going to triple. But the circumstance is the same, stock after stock after stock. Great, unrelenting uptrends, strength, and now real hits that have carried them down as much as 45% in the case of an MU or a Robinhood.
Yeah. So I want to hit one other name that you're going to say it looks the same, but it's Eli Lilly. Okay. So
Yep.
again, this is look at where this stopped. And last week on Fast Money, we did a whole segment on it. There was another drug or one of their obesity drugs just got approved or had really good trials for something else they could write scripts for and the like here. And I said when this thing was, where was it? It was that day where it was trading at 834 or something like that. I said, there's a gap all the way down to 740. And if it gets down there, it looks like a pretty interesting level. You take a couple turns off its multiple from a technical perspective, it gets back to that consolidation period before it started grinding higher. So how do you think of something like this? Again, you don't give a crap about this is a pharma. We just looked at a bank. We just looked at a semiconductor.
Right, because that's the point. They are the same. They are. No one wants to. No, people don't like that because they're like not the same. Lilly is drugs. That's a bank. I was the valedictorian in my high school, and then at Harvard Business School let me go in, and I work at Gold. Listen, it's all the same. That's ego, thinking one can outsmart. Pay attention to price. The concepts are the same. They're immutable, and they've been going on a long time. Uptrends and downtrends, reversals from bull to bear to bull. So is this a sell-off? Sure it is. Is the sell-off coming on the heels of a great advance? Yes, it is. And so where do sell-offs come to rest? Hard to know, but we use moving averages to try to help us. This is down to a level where, should we short it? Take fresh money and short this thing. That's bad technique. Should we buy it for a bounce? Risky, but I'd rather do that.
All right. One more. I'm just going to keep saying one more until we get to 2 o'clock. Amazon. Okay. This had a gap down 10% last Friday. Okay. The stock had already been down from 200 to kind of 180. So it was already down nearly 10%. Then it gaps down 10%. Today, at one point, it was down 8% or something like that. Here it is. Same thing, closing or, trading near its highs of the day. What does it mean that there was already a preceding gap lower? And here we are below all of those all of those moving averages and the like. Does this one look any different to some of the other ones? Because it did gap on fundamental news last week.
Right. So the drop-in gap versus a non-dropping gap, that's a big difference. But what we know is this is a leading security in the market that is around 24% in 2 weeks. All of the value it's ever created since its inception, selling books at a loss, they lost a quarter of it in the last 3 weeks. Do we buy it here? Because 10 years from now, Amazon will be higher. 10 years it will be, but I don't do 10 years, right? Some people do. That's fine. Do we short it here because it's already intraday recovered so much because the bear market's coming and the recession's coming and ultimately it's going back to 120? That's perfectly good if you have that view. But the point I'm making by saying those two extreme things, they're both valid. It's about your time frame. My own hunch is that this is already recovered intraday to the point where you now have set goalposts on an intermediate basis. The 200 high of 3 weeks ago, are we going to exceed that between now and Friday? I can tell you the answer is no. It's 162. Are we going to exceed it by now and the end of August? No. Okay, how about September? Point is that high at 200, that might be good for now and the rest of the year. Now, on the other hand, today's low at 151. We're trading at 161 now. Is that at risk of being undercut? Sure. But how much more? 140? So this is where I would do that. Like I'd sell. Again, no one does it, but it's a good business if you have the stones for it. You sell the 140 puts, you sell the 190 calls, which means you're willing to get short this stock at its all-time high of 200 after you take in premium, or you're willing to have this put to you at 140 plus the $10, $15. Are you willing to buy Amazon down 40% from its peak? I would think so.
Yeah, no doubt. All right, last question. I swear, I've been making this case that I don't know why so many investors, thought that this, like a name like NVIDIA, like it was just infallible. It was different this time, right? And I go back to late 2021, where a lot of folks were making the same argument about metaverse, about spatial computing, whatever it was, okay?
Mm-hmm.
And, that stock, Netflix, Tesla, a whole host of stocks lost 70% of their value. Some of the COVID darlings lost 80% of their, PayPal, a Zoom. I mean, the list goes on and on and on. Like, why can't we go into a period like we did in 2022, where the S&P at its lows was down 27%, but some of the prior darlings were down 50, 60, 70%. I'm just curious, what's different this time about this? And I know they're going to say, well, this is transformative. You know what I mean? This is so different than that. Well, you know what? People were saying the same thing about metaverse versus almost every trend before, crypto and IoT, the Internet of Things, and the list goes on and on. So just really quickly on that.
Yeah, I mean, look, NVIDIA dropped 68, 69% in the 2022 bear market, and it's down, what, 35% here, half of that. And so, sure, there's plenty of, but again, it's on an intermediate basis, having dropped 35% down to a level of support. If one, it's not a question of whether one buys or sells, even though 99% of all capital is long only, short selling is a small fringe thing. To try to prove or test out the premise, should we buy it or sell it? Proof by contradictions. Would we short this thing down 35% right here? I wouldn't do that.
Yeah.
I don't really want to buy it either. And that's the thing where maybe you sell volatility.
Yeah. I mean, here's one that I wouldn't be selling volatility on, because on August 28th, they're going to report earnings. And I'm just saying, if they guide below where the street is, it's lights out for this thing. So, that's my 2 cents. All right. Carter Braxton Worth, we really appreciate you being here. You guys go.
All right. Happy August.
Service. It's
All right.
absolutely amazing. WorthCharting.com. Oh, look at that. Old fashioned technical analysis. Nothing slick, just charts. All right. Thanks, Carter. Look who's here.
Hi.
Liz Young Thomas.
I'm here.
That doesn't roll off the tongue yet for me. Okay.
Keep practicing.
Thanks for being here.
Yeah.
Look at
Thanks
you.
for having me.
I mean, this is amazing. So we've just had a really fun hour. We had Guy and me for the first 30 minutes.
Yeah.
We had Carter and me for the next 30 minutes. Now we have you and me here. How fun is this? So let me just tell you a little bit about what Guy and I did, because I know you weren't watching. You were running around from your office over here. So look at those tricked out. You see those pennants that we have?
Yeah, those are new.
Aren't they pretty cool?
They are amazing.
Yeah, right.
We need a megaphone.
So Guy and I, we went through what we thought was like the anatomy of a sell-off, some of the kind of reasons why we did what we did over the last week or so.
Sure.
Carter, you just heard us a little bit going through some of the charts. I'd love to hear from you. I always find it fascinating, some of the sentiment that is around a SoFi customer, because I know you write for them, you do podcasts for them, you present in front of them. And again, one of the things I always find fascinating is a lot of them are, like, let's say 20 somethings and 30 somethings, right? Does that make some sense? They're kind of new to the markets. They probably didn't have a lot of experience during the financial crisis as it relates to investing and how they think about taking risk and the like. What are some of the things that you've told your clients? And this goes back to, I think, late 21 and 2022, the uncertainty. No one knows when a market's going to bottom. No one knows when volatility is going to crescendo the way it did. So talk to me a little bit about that sentiment, because I think it's really important.
Yeah. So, well, first of all, question, if we're talking about the anatomy of a sell-off, where, like, head, shoulders, knees, and toes, where are we in it?
Well, we were, all right. So really quickly, what I think you will agree with this, because these are things that you and Guy and myself have been talking about, I think, for months now on the Tape podcast, and obviously here. So, a few things here. I think that a lot of folks were kind of late to what's going on in Japan, but when you see the Nikkei down 12%, overnight, that is waking up a lot of people to that sort of situation over there. Okay. So you have that, you have air coming out of the generative AI trade. Okay. And what we've seen from some of the biggest players in that space, the hyperscalers, the ones who've been buying tens of billions of dollars of, high-end GPUs. And then the news over the weekend that NVIDIA might be pushing out, they might have design issues, putting Google, Microsoft, Amazon, Meta on their heels if they can't upgrade to these things. So we have that going on. We have the ratcheting up of the situation in the Middle East. We could have a much broader situation. Iran has actually joined the party in some ways, not just backing some of their proxies, with Hamas and Hezbollah. So who knows what's going to happen there? Uncertainty about our own election. Guy and I talked about the last month in our politics here felt like a year, or it's one of the weirdest. So there's a whole host of things. Oh, and then the consumer. So we talked about some of that data, ISM and jobs. So to me and Guy, and I think you agree, you mash that all together and you get what we had here last week.
Right. Last week, and then it
exacerbated
today.
Yeah.
So I did an interview with the Washington Post earlier today, and
Stop
basically
bragging.
the question
Yeah.
was, what's going on? Why is this happening? And I think what people want is one answer, right?
Yeah.
What caused this? Did Japan cause this? If it's Japan's fault, then it's as if it's going to make us feel better to know what caused it.
Yeah.
But as you just outlined, there are layers of issues here. So the way that I would see it, and this is you framed this question as, how do younger investors look at it? I think individual investors in general, if they're not in the industry and they're not sitting in front of a machine that's telling them a bunch of different things at the same time, all they're seeing is headlines.
Yeah.
So they see headlines like you said, Japan down 13% overnight. Japan went from zero to bear market in 3 trading sessions.
Crazy.
Nobody likes to see that
No.
headline. That's terrifying to see. And Japan is a important country. So it's not as if we got news that some tiny little country
fourth,
and,
fourth
some
largest economy in
emerging
the world.
some frontier market. So that's a spooky headline. And that's on the heels of 2 pretty bad data reads in the US last week, bad manufacturing number, and then a weak jobs report. And when you talked about politics, the last month has felt like a year. I think right now what investors are grappling with is we just heard from the Fed. We're supposedly not going to hear from them again until September 18th to do a move. That feels like an eternity.
So we have what
from
Jackson
now.
Hole is what
We have
August
Jackson
22nd.
Hole, but they're not making a move that
Well,
day,
they're
right?
going to signal. Hey, listen,
They're going to have to talk about
folks
it.
are pricing in, and all morning I just heard like a surprise rate cut. I just want to bring you back for 1 second. Late 2018, the Fed pivoted in between meetings, and that kind of put an end to that sell-off. It was about 20% in the prior few months. And then I go back to, I think you were probably in 8th grade. Where were you in the year 2000?
I graduated high school in
January
2000.
All right, so January 2001, the Fed came, I think, the second trading day of the year, and I think they lowered interest rate 50 basis points. And what's interesting is that, I think going into the bear market, no one knew it was going to be a bear market that started basically in Q1 of 2000. The Fed funds rate was above 6%, which is pretty fascinating. And, we got to high end 5.5% here. And so their ability to lower and even do surprise cuts is there if you start seeing weakening data and, you know what I mean? So talk to us a little bit about that.
There was a lot of chatter today. It's kind of stopped now, or at least it's slowed down, about an emergency cut that the Fed has to do something. So here's my take on that. The only way the Fed is going to do an emergency cut between now and September 18th is if financial markets stop functioning properly. We know that the economic data has weakened. We expect it to continue weakening. So does the Fed. So that I don't think is going to scare them unless there's something that's incredibly weak. Like we get a CPI number that's below 2 suddenly or something like that.
When is CPI? Is that coming up in a
It's
week
usually
or so?
around the 10th of the month.
I'll
So
tell
we
you,
can,
I'll tell
I
you.
want to say it's August 13th, but I might be wrong about that. So CPI usually is around the 10th of the month, and then PCE is later in the month. But we're going to get 2 more CPIs before their September 18th meeting. So unless there's some economic data that really surprises to the downside, I don't see them doing an emergency cut because of the economy. The speculation about it now is whether or not financial markets will be able to withstand further volatility. They functioned as they should have today, right?
It was panicky.
It was panicky.
That takes you back to.
My point is, we didn't have like oil trading at negative $40 a barrel, right? Nothing got completely dislocated and stopped functioning. We didn't hit circuit breakers in the US. That's the kind of stuff that would start to tell the Fed the market is not functioning as it should. So we're not there yet. And obviously we've given some of this sell-off back already. We've recovered quite a bit throughout the day. And then bond yields. I think the bond market is the other key here. If the bond market, particularly the treasury market, freaks out, it'll perk the Fed's ears up and they'll have to at least say something, right? What I think would happen first is we'd get an emergency press conference with no action.
Well, it's funny. So we just had our fast money call. We do it at 12:30. So we have our producers, we have the, folks that are going to be on the desk, and then Melissa Lee is always on there. And I think they said that there is a, what's Mary Daly, who's the San Francisco Fed speaker, governor. I don't know if she's got voting or not, but they were like, oh, she's speaking at 5 o'clock today. So every time now a Fed speaker is out there, it's going to be picked over in a big way.
Hanging on there
also,
everywhere.
by the way, it's August 14th when CPI comes out.
I was close.
Yeah, you were close.
Okay, so here's where we are now. Earlier today, the market was pricing in 75 basis points in September. Now we're back to 50, which I think is still reasonable. We're between 4 to 5 cuts by the end of the year.
Which is funny. It's back to where we were
Yes.
like 6-9 months ago
Yep.
when a lot of folks were expecting that, but they were expecting it for all the right reasons, that the
Yes.
Fed had the ability to put a little mission accomplished sign up there.
That's right.
Yeah.
So here's what I think the contradiction is in some of the commentary about an emergency cut, as if they should come out and save it if things continue this way. An emergency cut is only going to make the fear worse. If they come out before the September 18th meeting and say, we need to cut 50 now, we're also going to expect another 50 in September. And then we're chasing the market down because they're trying to prop it up. That never results in good things. So we do not hope for an emergency cut. Now, of course, if things get completely haywire, and like I said before, financial markets stop functioning as they should, yes, the Fed will probably come in and do an emergency cut. I think we're reasonably far from that right now, but who knows what the next couple days hold. I had a completely different thought last Wednesday even.
Yeah.
So back to what investors do and how they feel in this. So younger investors, depending on when you started investing, there are many younger investors and many on the SoFi platform too, who didn't start investing in earnest until the pandemic. And there were some bad experiences in that, maybe with crypto or GameStop, right? Some of those meme stocks. But now we're in a place where what we know from our research is that younger investors want disruptors, right? What are the names they want? They want disruptors. They want the headline makers. They want, they don't want banks. They don't want energy, right? So there are certain sectors that they end up very concentrated in. Technology is one of them, but certainly not the only one. There's also discretionary, there's communications. And then they want, the things on the fringes, the Rivians and the cannabis stocks and things like that.
Well, they don't want much of them because those things trade like ass.
Right. But the popularity of them, just generally because of what you're exposed to as an investor today and what's been going on in the market and driving all of that enthusiasm, is that I think what's happened to people is that they've gotten so concentrated in little pockets of the market that something like today, or even what started last Thursday, can be really spooky. And the idea of watching an account that had an unrealized gain of 80% go from 80% unrealized gain to 20% is really terrifying. So that's what's panic inducing. And if you don't have the experience and the wherewithal to sit through that and say, I shouldn't panic and sell this as it's coming down, right? Then that's when people exit the market and stay out for a while.
Which is the biggest, that's the biggest mistake people make.
And younger investors tend to do that, but individual investors, period, tend to do that. It's easy to get out when you're scared. It's really hard to get back in. So that's probably one of the bigger things
so
that's
I
happening
have two things on that. And, again, I know this is something that you probably not only tell, the folks that are on your platform, but also when you get asked questions about, what do I do here? And you always say, well, you got a dollar cost average. You always have to be in the game, right? And so if you're doing that, you're doing that on the way up, you're doing it on the way down. You can do the math, like how that works for yourself, especially if you have a longer term time horizon. The one thing I'll say is that younger investors who are more apt to take more risks, they have more time to work it out. And if they are long-term investors, that's great. But when you think of some of the gains, like Tesla's a great example. Maybe they can throw that chart up, a 5-year, okay? And go back to that 2021 period where, rates were really low. And, like folks, it was like an orgy of risk taking back then, right? We had all these SPACs coming due. We had all of that stuff that was working in the pandemic, and no one could see any of that ending. Well, look what happened to a Tesla. That was one of the best COVID stories. I don't know why it was a COVID story, but it was like everybody was obsessed. Look at that bottom left there. That was the COVID sell-off. Look at that. I mean, is that crazy?
That is
all right.
crazy.
Well, look at it here. It went from 400 down to 140. You know what I mean? Now, if you believe in Tesla and you believe in Elon Musk, that's been a really painful period. So at some point, you have to look to take some profits, especially if you are doing individual names, right? Because I always say to people, be exposed to broad markets, be exposed to maybe different, subsectors in the market or internationally. I know these are things, or small caps, or, have some bonds, all that sort of thing. If you YOLO like individual stocks, meme stocks, whatever, at some point, if you don't take a profit,
Yeah.
you can't book a
Right.
gain. You know
Well,
what I mean?
and it's the same principle. Don't fall in love with your stocks,
Yeah.
right? Because the idea of YOLOing into something is that really what you're probably hoping for is to be a hero in your own portfolio, is
Yeah.
to get it and then get this huge gain and make a ton of money on one thing. Of course, that's possible,
Yeah.
but you do have to manage your own risk on the way up so that the way down is not as painful. One of the things that I am encouraged by, that we did this survey in early 2023. So after the painful year of 2022,
Yeah.
we asked our members basically, are you planning to invest the same amount or more or less next year? And this is after they experienced the volatility. 74% of them said they were planning to invest more the following year. So they didn't get scared out of it in 2022. I'm encouraged by that. I'm also encouraged by, we know what's happened this year with more individual investors starting to perk up about, maybe I should invest in treasuries.
Mhm.
Maybe I should invest in gold, right? We started to get questions like that from people who wouldn't typically have been interested in investments like that, because they thought they were boring. They were of the old guard. And why would we ever do that? So hopefully there's more diversification in a portfolio. And the other thing, I say this to myself in my head all the time. It's something a yoga instructor used to say in class a lot. You don't have to be in it all the way, but you have to be in it to play. And it doesn't mean in it as in you got to be in individual stocks. You got to be in the S&P 500. You're still in it if you're invested in treasuries.
Yeah.
You're still in it if you're invested in utilities. So you just have to be in what you really have conviction in is going to work, and make sure that there are things in your portfolio. Like if you pull up your portfolio on a regular day, let's say the S&P is down 1%, okay? Not a big deal. There should be things in it that are red and things in it that are green. If they're all moving in the same direction on a day that's not extreme, I would argue you're probably not diversified enough. So looking at a portfolio from that perspective, and I do say that to people a lot, you should, unless it's an extreme day, you probably should never see everything in your portfolio the same color.
Yep. All right, let's hit one other thing that the young folk are really interested in, and that's Bitcoin really quickly. This is one of the pillars of the bull case for years has just been a store of value. I've been arguing that, again, it's just become a macro risk asset, but one that is correlated to the NASDAQ and highly correlated. When you think about, this is pretty interesting. So if you pull up a 1-year chart, you look at the high of this cycle is in March, and then you see, some retests of that high. We never get above it. So we see a bunch of kind of lower highs here, going back to just a couple weeks ago. And then you look at what happened today, it looks not too different than what we saw in an NVIDIA or, a Tesla gapping down 10% or something like that. So it's made back some of the gains. So I just find it interesting. Again, you can dollar cost average this thing. Some of the narratives around it was that, with all these ETFs, it was going to make it that much more accessible. People can buy it in their IRAs, but just be clear, not a store of value. To me, it's a really good, semi-liquid, like risk asset that, from a macro perspective, people are putting it in as it relates to the dollar, as it relates to gold, as it, some of the, it was meant to be uncorrelated to traditional risk assets. So talk to me a little bit about this.
So if you pull up a longer term chart, can we do like a 3-year chart of this right now? So you can see that the crypto winter, right, that happened, that big long dip, and then the rise that has happened since late 2023. So yes, this drop on the most recent period is dramatic. And I think right now what's happening is that it's trading as if it's a risk asset, purely a risk asset, right? And the NASDAQ is down. I think there's probably a lot of overlap between people who are overly indexed to the NASDAQ stocks and overly indexed to Bitcoin. So the correlation there to me makes sense, especially on a day that's wrought with fear. The rise that we're seeing here, because I think the speculation is, okay, if Japan continues to squander and the yen causes more problems, the carry trade unwinds, and we've got global currency volatility up the wazoo for the rest of the year, I think the speculation is that crypto will come to the rescue, or that crypto will rally on that. My speculation is that it already did. So the rise that we see here in 2024, the re-acceleration of it, this whole currency volatility thing is not new as of last week. This has been happening all year. So I think some of this rise is already due to that. Now, will it recover some of this loss if the yen thing continues and the NASDAQ slowdown stops? yes, I think it will recover some of it, but I still think that this trades much more on risk appetite than most other things.
All right, let's talk about small caps for a second. And
Ugh.
I think this, I know, but I think it's interesting that a lot of folks were just really excited. They just were talking about the breadth and this rotation and how it's working into other areas that should perform really well. So don't worry about this. You know what I mean? So let's pull up the Russell 2000 for a second, because, you know, to me, you know, we made this, you know, put it on 1 year, if you don't mind, please. You know, we made this case that, okay, you know, you want the Russell, have at it, because, you know, it's basically the market cap of NVIDIA, right? So you're selling your NVIDIA because it's gone up so much and you're moving into the Russell. Well, look where it came back into, right in that consolidation period. It stopped right at the 200-day moving average. Fine. That's for now. Talk to me a little bit about that rotation, because again, I just didn't think it was particularly interesting. I think that made that little bit of a flag. It couldn't really get going. Look at how much it's given back in just 3 trading days. The reversal on Thursday, the gap lower on Friday, the gap today, where it stopped. I get it. Thoughts on small caps, and we can also talk about the KRE.
Okay, so I'm no technician, but looking at the rise that we see there in small caps and the swiftness with which it occurred, that doesn't look sustainable to the naked eye, right? And sure enough, we round tripped right back out of it. I wrote about small caps a few weeks ago. It was about the return of small caps. I called it Peanut Gallery. And basically, okay, let's try to prove why this is happening. Is this happening for any fundamental reason? And maybe some of the fundamental reason is that earnings are supposed to pick up as time goes on. So into 2025, small cap earnings are supposed to get better, but that wasn't new news. That wasn't what drove this big rise. What drove this big rise was rates coming down on the expectation of a soft landing. And even to say that differently, rates coming down on the expectation as well of avoiding a recession. Now things have changed. So we round trip it and say, whoa, maybe we didn't avoid a recession. Maybe we won't avoid a recession. And one of the other things about small caps that people had been touting as why they should be bought is because they were so much more attractively priced relative to the S&P 500. Now they're still technically more expensive on a PE basis, but relative to the S&P, the ratio was really, really low. You don't buy things just on valuations. They still have to have a point in the future. So in the piece that I wrote about small caps, I went through, here are all the reasons that people are buying them. I understand that. The caution I'd provide is this: as the Fed embarks on a rate cutting cycle, markets tend to cheer it initially and even for a short period after the cuts begin. But if that cutting cycle occurs in concert with slowing economic data, disappointing earnings, or a quick compression in multiples, small caps would likely lose steam quickly. And that is what happened. Small caps are also a risk trade, and small caps are a trade that are for early in an economic cycle when things are expanding, accelerating, unemployment is coming down, not going up. Growth is going up, not coming down. Inflation is rising because demand is strong. We are not in that scenario. So the rise that we saw here was, in my opinion, purely based on market factors that were going on, not based on small caps suddenly are healthy.
Yeah, and you've been talking about a late cycle sort of situation, and you know, if it just literally joined the party right as the economic data is starting to be noticeably weaker, you know, I think that's pretty interesting. Really quickly, the S&P, this is the regional banking index, the KRE. We don't have to spend too much time on this, but it looks exactly the same for the most part as the Russell 2000. Let's talk about some sectors that really interest you. Again, if you're not so sensitive about the short term, are there any that you want to start picking at a little bit that might be maybe defensive if you think the market is going to continue to be, you know, volatile, hacking around here a little bit, but maybe the highs are in for this year, right? And so you know, the fact that volatility's picked up the way it has, forget the VIX. I mean, people spend so much time on the VIX, and, you know, maybe it's a good timing tool when you see the sort of spike that we saw today, but we did get a big move off of today's lows. And you heard a little bit about what Carter was saying, you know what I mean? After this sort of move, you might see a calmer sort of period, you know what I mean, going forward. But to me, what's different about that is that, you know, we have a macro event, which is, you know, NVIDIA's earnings. And I can't put too fine a point in this. And I've been saying it for the last 2 quarters. And so maybe I've just been early, but at some point they're going to guide lower and they're going to guide below where the street is. And that's going to take even more air out of this, generative AI trade. What does that mean? It means Microsoft, Amazon, Google, and Meta, and then a whole host of others. Look at what Dell's done. If we just want to pull up Dell for a second, this was meant to be a huge beneficiary of this because, the chips that go to the servers, that go into the data centers, you know what I mean? Everybody wanted to draw a line through all that stuff. I mean, look at that move and look at that gap from, I think, February, March or something like that. That's when it joined the party. It kept on going unabated. And then they gave guidance that was less than expected. And look what happened from those highs. So that to me is a big event. Then we have Jackson Hole. I think August could continue to be very volatile, especially as folks start to try to handicap what happens with the Fed. And I think there's no doubt in my mind, the Fed on Jackson Hole, they're going to signal something if they have not already done, they have already not done a surprise rate cut.
Yeah, I think, so Jackson Hole, I think, is with the 22nd or 23rd of August. If we have more days like this, we're going to hear from them before, and not even them. We're going to hear from Powell before then. So I would absolutely expect some kind of press conference if this continues. About the VIX, that's another one of those headlines that's going to freak individual investors out, right? You see a headline that the VIX went to 65 and we were hovering at 12 for however long. It's still, it came back down, way back down off of that. We're at 34-ish right now, but 34 is a lot higher than we were. So this is a different market now. And I think it's going to stay a different market. Even if the VIX goes down to the 20s, that's a different market than the VIX at 10. So it's something that we have to definitely heed the warning of. When you look at you asked about sectors.
Yep, let's do it.
I'm looking at the dollar right now. So I talked about this in my mid-year outlook. I continue to say it. It's not just that you should suddenly be in defensive sectors, but you have to think about what's going on in the dynamics of the rest of the market. I talked about it in that outlook that I would expect there to be a bull steepening. I continue to talk about there being a bull steepening. For a period of time today, we had such an aggressive bull steepening that the yield curve uninverted at the 2s, 10s. A bull steepening means that both the 2s and the 10s are falling, but the 2s are falling faster. Now, why does that matter? It matters because today was a perfect illustration. 2s fell in the overnight session or in the pre-market so strongly because everybody thought the Fed has to come in and save this. This is terrible in the short term. We're really worried, right? So then you see this big plummet in 2-year yields as people clamor for assets that are safe. As a bull steepening occurs, what we've done is look at all of the research of in those environments, which sectors tend to do better. The ones that tend to do better are the classically defensive sectors, things like healthcare, utilities, and staples. Part of that, especially for staples and utilities, is a dividend play. A lot of the dividend paying stocks or higher dividend paying stocks are in those two sectors. There's also a decent amount in energy. But dividend plays become more important as short-term rates fall that quickly because anybody sitting in cash, which we know we've had record numbers of people sitting in cash or money markets, no longer is going to get as attractive of a yield on that cash. So they want the yield from somewhere else. So dividend stocks start to become more attractive. So I would say youth, staples, healthcare, but dividend stocks in general.
All right, let's just pull up XLU for a second, the ETF that tracks utilities. Let's just do a bit of a speed round here. So that was making new 52-week or multi-year highs. Again, that could be a sector that you want to kind of maybe pick at if it were to go. I want to look at XLV. Okay, so that goes to your healthcare a little bit. When you look at this, again, not far off of its highs. I mean, it was just making one early on Friday morning. That might be something, it sounds like, that you want to pick at a little bit.
But be careful with this one because in an election season, and we've got a lot of uncertainty that's still going on, as the polls change and as we hear more about Kamala's policies around healthcare, this is going to see some volatility. And we don't have a VP pick, right? There's a lot still that's going to happen even this week surrounding the U.S. election. So healthcare could be pretty volatile in the next.
All right. What about banks? BKX. Let's look at this really quickly. Again, this was making new highs about a week ago. That's 52-week highs, but you had that sort of, pullback. You see that moving average there. JP Morgan, again, was making, new highs seemingly every day for about a month and a half. It was just at highs the other day. It sold off 4.25% on Friday. It's down about 2% today. BKX, are banks interesting to you in a flat yield curve environment? And we've already had the twos kind of get in front of whatever the Fed does in the near term?
So banks traded up on, again, a similar idea as small caps, that the yield curve was going to flatten or re-steepen absent a recession. The big drawdown here is that we no longer feel like it might be absent a recession. So now we're trading more on the cyclicality piece of it. I think that banks become more attractive if we go through a shakeout, but we need to go through an economic shakeout and a market shakeout first. So they were being treated as blue chips and safe havens for a while, but naturally, just like any other cyclical sector, they will feel the pain if economic growth concerns are what is driving the bus, and that is what's driving the bus.
And that's something that we had been talking about the last couple of months, or a couple of weeks, excuse me, that at some point, banks are going to come more correlated to what else is going on, the things that are moving because of the economy. I want to pull up Staples, XLP. You just mentioned them before. On a 1 year basis, you see where this has come from. It's pretty impressive, especially given some of the things that we heard from Pepsi and some other consumer products companies. Look at it on a 5 year basis. Pretty interesting. You look at this kind of consolidation that it's been in. It's very near those prior highs. Staples interesting to you? Obviously meant to be defensive.
Yeah, I've been holding a Staples ETF for a while, and it's done really well. Yes, they're interesting to me. Of course, there are going to be companies in there that are disappointing, but in a downturn, if that's what you think is happening, and if it continues to be economic growth concerns, Staples should do well. You can get even more granular with it. There's an ETF called PBJ, which is a food and beverage ETF. So looking at the really Staples companies that people are going to the grocery store to just buy cereal,
peanut butter and jelly.
Exactly.
I see what you did there.
Yeah, I mean, I didn't name it, but it is clever.
Yeah.
So you can get even more granular if you want to go into the people, saving money by buying at the grocery store and the stuff that they can't do without.
Yeah. All right. Let's look at energy, XLE. This is kind of interesting because it had a very bad last few days. Guy and I were talking about this in the beginning of the show. When you think about what's going on in the Middle East, and then you think about growth concerns, they're kind of balancing each other off a little bit, right? And so we've seen crude, it got as low as 72.5. It was trading at 82.5, I want to say a few weeks ago. Thoughts here, because again, what would you kind of place a greater emphasis on, growth or lack thereof, or tensions in the Middle East?
Well, right now I'd place a higher emphasis on growth, but I'll tell you what we don't need is a big spike in oil, because you add that to the mixing bowl, you've got a perfect recipe for a downturn, a global downturn, because as we know, spikes in oil typically precede recessions as well. So still to be seen at what happens with Iran. As far as I know, we're going to find out what happens in the next 24 to 48 hours or so. And there's been a lot of threats. So this is definitely something to watch. I don't think it's something that's driving today, but it's definitely not going to help matters if it escalates.
All right. Last one, and let's take two questions. You got time for a couple questions? All right. Let's look at the SMH and we'll look at the IGV. These are two that, you've been tracking pretty closely. I know that, again, SMH has not been your cup of tea. A lot of it has to do with the excitement, first and foremost, around generative AI and how narrow the trade had become between NVIDIA and Taiwan Semi. And I know you're not focused on individual names, but really, what are the drivers of the massive outperformance here? That's kind of worried you a little bit.
Yeah. And look, I'm not a SMH hater. I mean, I absolutely wish that that little dip in November of last year, I wish I would have started saying buy. So of course we all wish that we would have made that money. It's the concentration of it that bothers me, and not just the concentration, but as it went up and this has happened for a long time now. It's been going up for a long time with, in my opinion, not a whole lot to show for it.
Yeah.
So it's been all on future plans, all on future expectations, which is how the market trades. I get it. But at some point, and in my opinion, at some point in a 12-month period, because we trade on forward 12-month earnings, you have to show what's going to happen from a tangible perspective. And that means profit. That means, is the competition really coming in?
Right. But that's why there's a couple pieces of news, the fact that, NVIDIA and their CEO have been talking about the kind of product roadmap, right? So we had H100 this year, we had Blackwell next year, we had Rubin the year after that. So over the weekend, the information is, reporting that they're pushing out Blackwell due to some design flaws, and that's going to put, their biggest customers on their back feet, that sort of thing. But given what we just heard from their biggest customers in Q2 earnings season, I don't think they want the chips. I mean, like, to be honest with you, without the monetization. And so, this goes back to a month ago or maybe a little longer, where Elon at Tesla is telling a story that they're no longer an EV company. They're a robotaxi company and they're a humanoid company. And to do that, that means that they are an AI company. And they were to get $500 million worth of the really difficult to get, supposedly, H100s from NVIDIA, and they diverted them over to XAI, which is his AI company. So that doesn't, that doesn't square with me. I don't get that. And if the robo taxis are going to be built on, like generative AI, well, wouldn't you think they need those chips? So to me, I think he's full of shit, as you guys know. And I think, no, I'm just saying, like, totally.
I know you do.
And so, like, that's really interesting. The last one, I want to get to IGV. So this is software.
Yeah. Okay.
Pull it up, do a 5-year. Jacob, like, just put the double top in there. I mean, it's pretty fascinating, right? We've been talking about that. So you see the double top. We've been talking about how a lot of these SaaS names have been massively underperforming anything related to generative AI. And then if you want to draw an uptrend, right, from those 2022 lows, this price action, we just violated it. So if you care about technicals, I think that's pretty interesting. I think the 200-day is in the offing here. So IGV relative to SMH, I know I kind of led the witness there, but
but they're both
software
going down, right?
Yeah.
I mean, and that's not a good situation.
Yeah.
It's similar to, and I talk about this as a comparison all the time, staples versus discretionary. If you pull up charts on that, if they're both going down, we're in
but
we're
discretionary
in an indiscriminate selling
XLY
situation.
is ready for this, and we'll pull this up in a second because Jacob's just making this very fine chart. Yeah, no, it's a little bit through there. That's fine. Let's go to XLY for a second here, because this is discretionary. And you know how we talk about, construction of ETFs. This is a kind of bad one, and I'm going to tell you why. If I go on my FactSet machine and I go to the components of it, look at this for a second. The largest component is Amazon at 21%. The second largest is Tesla at 16%, and then Home Depot, then McDonald's, Lowe's. I don't really see McDonald's as discretionary, but Amazon I don't really see as discretionary either. Tesla is definitely discretionary. So we know that, the housing situation, may be kind of difficult with Home Depot, but 40% or so is Amazon and Tesla, and just not a good ETF. Do you agree with that?
Well, it's skewed. It's very skewed, and it's with companies that aren't really uniform.
But if you look at the XLP, for instance, it's Procter, it's Johnson and Johnson.
That one makes more sense.
Yeah, no, it's a much better.
That one makes a lot more sense.
Yeah,
and just real quick about software too. Yeah. And you have to think about this logically. So software has been the redheaded stepchild of technology versus semiconductors.
And by the way, we like redheads here.
Okay.
It's just an expression.
I like stepkids.
See? I see what you did there. So ginger stepkids, good by you? Yeah.
Nothing against either of them. Yeah. But software has been the unwanted thing in technology. If we are in a period where investors are worried about the discretionary spending of corporations, which I think we are in right now, they've been more discerning. They've been punishing corporations for spending too much. Software suffers in that cycle because software obviously is a pretty big spend for most corporations. So this going down at a time when we're worried about corporations sticking with their contracts or increasing their contracts shouldn't be a surprise. I don't think it's necessarily a very clear cyclicality signal in either direction, because software and semis are both going down.
I just want to make a point about software. So a couple years ago, SaaS coming out of the, this was like the hottest thing in technology before we were focused on generative AI. And I just want to read a couple names. This was a late 2021 IPO. It's a Snowflake. It's down 42% of the year. Salesforce is down 9% of the year. Adobe is down 15% of the year. Twilio is down 20%. I mean, the list goes on and on and on. Okay. So it's just interesting. If you don't think your favorite sector that's totally in vogue right now can really massively underperform. All right, let's take two questions and then we got to get you out of here. I know you're very busy today. I think this is an interesting one. This is from Donald Clayton. When the Fed cuts, which they will, are we going to have to deal with inflation again? So you kind of alluded to this a little bit as it relates to crude. You did for geopolitical reasons, but if the dollar were to get weaker and we were going to have, some sort of, further escalation in the Middle East, are we likely to see in a lower rate environment, crude oil going back higher? Or what are some of the knockoff effects from that?
So first of all, yes, I do think we would be likely to see crude oil going higher. That is an exact reason why the Fed uses core, right? That's why they use core PCE and core CPI, because it removes energy, and they shouldn't make monetary policy decisions based on short-term tensions in the Middle East that are going to cause a short-term spike in oil. So will crude get affected? Will oil prices get affected if that happens? Yes, absolutely. Will gasoline prices get affected for a short period? Yes, absolutely. Do I think that if and when the Fed starts cutting rates, let's say it's September for now, do I think it's going to reignite inflation? At this point, no, I do not. I think that we are now in a point where growth is slowing enough and inflation has come down because of it. And we've got the labor market cooling as well. I don't think we are as much at risk of reigniting it. What would cause a reignition is that demand suddenly outstrips supply again. And I just don't think the consumer is in that space either.
Why do you think, Fed Chair Powell said at a meeting, maybe it was a few ago, maybe it was January, February, that they weren't going to wait to start cutting interest rates until they, when they got to their 2% target, they were going to do it ahead. Why do you think they waited? You know what I mean? So long.
Honestly, I'm not sure
It's
why.
it's weird though, right?
I think I said this last week. If their intention was to begin the cutting cycle gently, they should have started already, because now it's not going to be gentle. And it's going to look a little bit more panicky, even if this all calms down.
But they couldn't even.
And they start with 50.
They thought they were cutting into a soft landing. You know what I mean? Like, so
they could have cut. I mean, now obviously hindsight's 2020. Now we know they could have cut. They could have cut by 25, and it probably wouldn't have been a big deal. I think they were very, very worried, and rightfully so. They were very, very worried for a long time about reigniting inflation or loosening financial conditions too much. I don't think anybody expected this unwind from last Thursday until today to be as dramatic as it's been. Had they known, had they had the foresight that this was going to happen, I bet they would have cut last week by 25.
All right. Eric Clifton, what level to play for a bounce in SMH? Again, we talked about SMH, but two names make up a lot of it. That's NVIDIA and Taiwan Semi. NVIDIA supplies 85% of the high-end GPUs, and Taiwan Semi makes about 85% of those, right? So when you think about it, NVIDIA designs them, Taiwan Semi makes them, right? So look at the SMH chart. You see that 200-day moving average. You also see that level in April that it bottomed out at. That's where it got bought today. You know what I mean? So what's interesting to me is that if you see a follow through to the upside, assuming that the SMH closes, let's say here or a little higher, and you have a follow through, it's going to fill in that gap from Friday morning, and then your guess is as good as mine. I'm a seller on rallies. I've been saying that in this ETF for probably a few weeks or so. I know I was kind of early on this on the way up a little bit, but to me, I'm thinking about the fundamentals of the components in this. I feel very confident that at some point we are going to have an unwind of this trade. Let me get one for Liz, and then we're going to get out of here.
Here's what I would say while you're bringing that up, though. Just generally about the market. Now, this is not intended to be dramatic or fear-mongering, but you don't have a day like today and then just move on and forget it happened. We didn't solve anything today, right? Now, some of it probably was driven by algorithmic trading, some of it probably driven by positions in short-term volatility. I get it that it was exacerbated and it was overdone, which is why we've recovered a decent amount, but things like this don't happen, especially 3 days in a row where we had heightened volatility and sell-offs. They don't just happen in a vacuum and then disappear. There are still dislocations in the market that caused this, and there's fear about an economic slowdown, or at the very least, a mispositioning based on what the real risks are out there in the economy. So I don't think that this is going to be over after today.
Yeah, no doubt. All right. Well, listen, I think that is covering a lot of ground. We've been here for an hour and 42 minutes. We really appreciate you guys spending the time with us. I appreciate Carter. I appreciate Liz coming into the studio. It's always great to see Liz. Look at you. You're always smiling, whether the market's crashing or it's making new highs every day. You're just happy, you know what I mean? Which is really nice, actually. So we appreciate that, Liz.
Thanks.
All right. Well, thanks everybody for being here. Thanks for your great questions. We appreciate it. Guy and I are going to see you back here tomorrow at 1 p.m. Guy and I are also going to be on CNBC's Fast Money at 5 o'clock. We're going to have a really exciting show, so check it out.
All right.
All right. Thanks, Liz. Thanks, everyone.